Welcome to CSIS Online. The way we bring you events is changing, but we'll still present live analysis and award-winning digital media from our Dracopolis Ideas Lab. All on your time, live or on demand. This is CSIS Online.
Hello, everybody. This is John Hamry, president here at CSIS, and we welcome you to this. Really is going to be a wonderful conversation. It's the fourth day in our sequence of conferences. The first day, we focused on the imperative of innovation for America going forward. And on day two, we looked deeply in the question of intellectual property protection and the crucial role that the government plays in helping inventors protect the rights to their ideas and what we do about that. Yesterday, we had a fascinating discussion about tech transfer, where these big engines of innovation, universities, how do they get their ideas into a commercial marketplace? And how do we balance that dynamic between public good and private good? And it was a very interesting day. Today, we now round out the most, whether it's the most important, but money is always the most important when you get right down to it. And we're going to discuss that today, looking at the way that we bring capital to this enterprise, and how do we look at innovation in the sense of the way venture capital plays such a crucial role. We have a fascinating lineup today of speakers, and I will rely on Kathleen Gallagher for running that part, and I will. But right now, we have the privilege of talking with Steve Case. And Steve, I want to say thank you for joining us today. It's a real privilege to have you. You are now in a very new phase of your professional journey. You're running a company called Revolution. It's a venture capital company with social purpose. But before we get to that, I'd like the audience to know you a little bit better. Of course, you are so famous for having founded AOL, America Online. I grew up with that iconic bell ring and you have mail. It was an exciting start to every morning. But before that, you were in a very different line. You were a product development guy for Pizza Hut, and so you've had a very interesting journey. Would you just share a little bit of that with us for our audience?
Sure. Great to be with John. Thanks for hosting this whole week, because it's obviously important topics for the country and its competitiveness. So I'm delighted to be part of it. In terms of my own journey, I grew up in Hawaii and went to college in Massachusetts, and moved to Ohio to work for Procter & Gamble, then moved to Kansas to work for Pizza Hut, which at the time was the division of PepsiCo, and then moved to Virginia to join a startup that promptly failed. But thankfully, two of the people I met there, and I ended up co-founding America Online in 1985. What's that? 36 years ago. And back then it was still pretty early days in terms of the idea of the internet. Actually, from a public policy standpoint, it's worth noting that in 1985, it was still illegal for consumers or businesses to actually be on the internet. It was restricted to government agencies and educational institutions. So we had to do some work for a few years to essentially commercialize the internet, open it up to everybody. And back then, only 3% of people were connected, and they were only online an average of an hour a week. So it was kind of the early days of the idea of the internet, but it's been amazing to see what's happened over the last really 3+ decades.
It's really fascinating. But how did this now bring you to this new phase of your professional journey, to the world of venture capital? How help us understand this latest part of your trajectory.
Well, the AOL journey was about 15 years from the time we started it in, as I mentioned, 1985. Then we merged with Time Warner in the year 2000, so about 20 years ago. And as part of that deal, I agreed to step aside as CEO. And so then had to figure out, okay, well, what am I going to do next? And decided rather than just start another company, I would work to back entrepreneurs, mentor entrepreneurs, and invest in entrepreneurs. And initially did that just sort of informally, and then formed Revolution about 15 years ago. And then we decided to turn it into much more of an institutional platform with outside investors as well, outside limited partners, about 10 years ago. And so for me, it's been a great kind of next chapter, because we do have the opportunity, really the honor of working with some of the greatest entrepreneurs, building some of these amazing new companies that are improving our our lives. And we particularly are interested in doing that in a more inclusive way in terms of trying to back entrepreneurs, not just the usual suspects who graduated from Stanford or are sitting in Silicon Valley, but trying to find entrepreneurs everywhere and back them and help them take their companies and their ideas and turn them into significant businesses.
Steve, amplify on that. You've indicated that you had a different vision, for Revolution, and it was not just a venture capital company that was going to concentrate on the hot spots, but it was going to have a different mission. Would you amplify on that?
Well, really for a couple of reasons. First is just that purely from an investment, kind of return standpoint, we believe there's kind of an arbitrage because so much venture capital focuses on places like Silicon Valley. Valuations there tend to be on the high side. Those same companies, if there are other parts of the country, valuations would be lower. But when the companies are successful and they get acquired or go public, that kind of essentially that regional discount kind of evaporates. So we think from an investment standpoint, it makes a lot of sense. And also just from an impact kind of purpose standpoint, it makes a lot of sense. That's the whole point of your conference. We need to kind of level the playing field in this country so we have an innovation economy that is much more inclusive of different people in different places. And we think that by kind of hitting the road and really finding entrepreneurs everywhere, not just in the few obvious places, that's a way to have an impact more broadly on the country. Some of this evolved from the work I did now over about a decade ago when I was asked by to co-lead an effort called the National Advisory Council on Information and Entrepreneurship that was part of the Commerce Department. That kind of led to the launch of an initiative at the White House called Startup America that President Obama asked me to chair. That led to joining his Jobs Council and leading some of the efforts around entrepreneurship innovation, which led to the Jobs Act and some other things. And in the process, it really, frankly, opened my eyes to the central role startups, new companies play in job creation. It's not the big companies. It's actually not the small businesses. It's the young, high growth companies that really drive most of the job growth. That was kind of news to me. So therefore, backing more startups is critical to creating more jobs. And the other part that was striking was the fact that so much capital goes to so few places. Right now, according to the NVCA, Bobby will be on shortly, 75% of venture capital dollars go to 3 states, California, New York, and Massachusetts. So the other 47 states have 25%. California alone, by the way, has 50%. So venture capital is sort of not every company needs it or wants it, but most companies that want to grow fast and create a lot of jobs and build significant businesses do decide to raise venture capital. But it's much, much harder to do that if you're in Detroit or New Orleans or Atlanta or a lot of these other cities than if you're in San Francisco or New York or Boston. So that's the other piece that we're trying to focus on from a business standpoint with Revolution, as well as trying to be an advocate for public policy for a more level playing field, for a more inclusive innovation economy.
Let me pick up exactly on that last point about having a larger public voice for all of us. You recently authored 2 very important essays. One was in the Wall Street Journal, and the other one was in a newspaper called The Hill, which is really concentrates on Capitol Hill readership. We're going to, by the way, to our audience, we'll make those available on our website so that everybody can just look. You can find it with us, so you don't have to go search it out. But can I just ask again, amplify what you were saying in those 2 articles, because it speaks to this question about public policy and how we should approach venture capital as being a leverage point to improve innovation and prosperity in America.
Well, it really is the core of this little conference this week, which is why, as I said at the beginning, I'm delighted you're hosting on it. Basically, if you look at the data in terms of our competitiveness, America, kind of 250 years ago was just a startup, really just an idea, kind of a fledgling idea. And like many startups, almost hit the wall, almost didn't make it, but the country kind of broke through and rose to great prominence and did that because it was a pioneering nation that was really embracing new ideas and a variety of people and kind of we led the way as a nation in the whole agriculture revolution, then led the way again with the industrial revolution, more recently led the way with the technology revolution, the digital revolution. And some of that's because as a country, we really committed to invest in the future. And in 1960, almost 70% of the R&D spending globally was by the United States. And that's part of the reason we were led the way and we're able to invent all these wonderful things like the internet or some of the technologies that came out of the Apollo space mission and many other things. Now, if you look at the data, we've gone from nearly 70% of global R&D to less than 30% of global R&D. Other countries are figuring out that embracing the future is a good strategy. Investing in R&D is a good strategy. And as others have stepped up their efforts, we've actually pulled back on our efforts. So one thing that needs more attention, and this is, again, part of what you're focusing on and part of what the Congress and the administration is looking at, including with the Endless Frontier Act, is basically increasing the amount of money going into R&D so we can maintain our competitiveness and remain the most innovative entrepreneurial nation in the world. That's number one. Number two is we need to do that in a more inclusive way. As I said before, right now, our innovation economy really helps a small number of people in a small number of places. Most people in most places are feeling left behind because they kind of are being left behind. And part of the reason is because of the lack of venture capital in those places that makes it harder to start and scale companies. Therefore, a lot of people in those places leave. There's a brain drain going from the middle of the country to the coast because that's where the action is. That's where the money is. And so it makes the places like Silicon Valley super vibrant, and they continue to launch a lot of amazing companies. But many parts of the country in the last 20, 30 years have struggled. And instead of being in growth mode, have been in kind of decline mode. We have to address that. And it's not just about the money. There's some, culture aspects around creating kind of risk-taking, kind of vibrant startup communities. And there's a lot of things that need to be done around celebrating the entrepreneurs. A lot of things that need to be done around the talent side. How do you keep the people you have and try to get back the people who left and create a place where people really want to kind of live. But the capital is a key part of that. And that's why it is so important to make an effort there. And again, some of the discussion now in Congress is around creating investments around regional hubs, which I think could be very transformative in terms of kind of leveling the playing field in terms of more of those places. So we got to increase our investment in R&D if we're going to remain the leader of the pack in terms of innovation. And we've got to do that in a much more inclusive way, and not just in terms of place, but also in terms of people.
So my last question, because we have a marvelous panel coming, but you just mentioned your advocacy for regional hubs. You've been working on this a bit. If you were testifying right now in front of Congress, what do you say they should be doing to help us create regional hubs?
Well, I think some of the legislation that has been introduced, particularly around investing in regional hubs. So this R&D investment spending doesn't just go to the same places, but goes to some other places and ties in with some of the work around some of our national labs, ties in with some of the innovation happening at universities. One of your panels talked yesterday about tech transfer, doing a better job of taking ideas that are invented and getting them into the marketplace, into the hands of entrepreneurs is critically important. But it starts with understanding that the country is at risk, that there is a risk that we will lose our lead as the most innovative entrepreneurial nation unless we really step up our game. And we can't just do that by backing more people in places like Silicon Valley. We need to do that by backing more people in other parts of the country, and do that by also backing more female entrepreneurs. Even though our country, half the population is women, less than 10% of venture capital goes to female-led companies. 13% of our population are Black Americans. Less than 1% of venture capital goes to Black founders. So there's a lot of work to do to really create a truly inclusive innovation economy. So the message to Congress is we have the opportunity to continue to lead the way. America has the opportunity to continue to be the most innovative entrepreneurial nation. But now we really need to step up our game. Others have figured out that the secret sauce that sort of powered the American story is innovation, is entrepreneurship, and it's sort of game on. So we have to step up our game and do it in a much more inclusive way, and focus particularly on really trying to establish this broadening of venture capital going to more places. We've now visited with our Rise the Rest bus tours 44 cities. Our Rise the Rest seed fund has invested in nearly 200 companies in over 70 cities, and we're seeing remarkable things happening in these cities. Just this week, there's a company in Atlanta, MailChimp, that got acquired for $12 billion. Most people didn't think a company in Atlanta could create that kind of value. We're seeing that all across the country. So this is a great opportunity, but we have to expand our aperture and not just do more of the same, And as we think about the pandemic, recognize it does create an opportunity now that we're kind of unbundling, uncoupling where you live and where you work. That creates opportunity for a lot of these different cities. And when we get through this pandemic, we don't want to go back to normal, because normal didn't work that well for a lot of people. We need to do better than that. And this is the opportunity to really embrace the future and really level the playing field.
Gosh, what a marvelous introduction for this session, Steve Case. You've set the stage. You've been very inspirational. I'm very grateful that you took the time to be with us. Let me turn to you, Kathleen Gallagher. Kathleen is the executive director for Five Lakes Initiative or Institute. Forgive me. Really a dynamic thinker. I mean, when we were planning this conference, I looked around and asked people, and boy, your name came up all the time, Kathleen. So we're delighted that you're here. Let me turn to you now and for the rest of the panel. This is going to be fun.
Thanks, Dr. Hamrick. I would say I'm a dynamic information collector, not thinker. So I'll be a good moderator. That you said you guys set the stage. I would say you set the bar really high. And this panel, I think, has the ability to take that challenge and act on it. Why don't we start out by, I'd like each of the panelists to introduce themselves. Why don't we start with Bobby Franklin from the NVCA? Bobby, can you tell us who you are?
Absolutely. Thank you, Kathleen. It's great to be with everybody. Very much appreciated. I'm Bobby Franklin. I'm president and CEO of the National Venture Capital Association, where we represent the investors in the entrepreneurial ecosystem. But I would say our entire policy agenda is all about entrepreneurs and what's important for startup and scale up companies. Sorry.
I'm going to ask if we can get Bobby in the spotlight with me. I don't like being here alone, and I'll keep going too. Next, we have Bill Slattery from Deerfield. Bill, can you tell us about you?
Well, good morning. It's nice to be with everyone this morning. I've been a partner at Deerfield Management, which is a healthcare investment firm, for over 22 years. Prior to that, 10 years also in venture and crossover early stage investing. Entirely in my career in the life sciences field, and life sciences is going to be a very important part of this entrepreneurial spirit as we're experiencing today and have for the past 20 decades. But they have some very unique aspects and obstacles that may be unique from other aspects of entrepreneurship and venture funding. So it'll be a pleasure to participate in today's conversation.
Thanks, Bill. And I want to say Bill is in New York City and Bobby is in the DC area. We should say where we are because we have a geographically diverse panel. Next, we have Zach Ellis from New Venture Capital Fund.
Good morning, everyone. My name is Zachary Ellis. I've worked in the venture capital space for a little over the last 10 years, primarily in the middle of the country in places like Wisconsin and Ohio. And I have recently launched a new venture fund in Texas. It's not yet been announced, so I can't say too much about it, but we're going to be focusing on underrepresented founders in South Texas.
Thanks, Zach. And last but not least, we have Bryce Butler from Access Ventures. Bryce, you want to introduce yourself?
Sure. Good morning from Louisville, Kentucky. So I'm a little bit unique. I actually run a private operating foundation that does venture investing. And so that's one of the things I think we need to talk about as it relates to capital is the amount of money that sits under management in endowments and pension funds that could be used to really spur some of this innovation in mid-America through creative kind of structure of capital. And so we're trying to spearhead some of that through an initiative called Render Capital regionally in Louisville and Southern Indiana, as well as some of our blockchain investments as well. So more to follow.
So as we can see, is there any way to get everyone in the spotlight just to the organizers? It'd be nice if we could look at all of us together, but I'll keep going. Let's start out. We've got this group of money people, and we all know, there are initiatives going on at the federal level to get money into. I'm hearing everyone can be seen, to get money into the rest of the country, and money's important. But let's talk about other challenges that you see in parts of the country that other parts of the country might need to think about, along with how do you use the money once you get it? And by the way, everyone, we're going to have a conversation, no like question and then everybody answers. So jump in, someone, and let's keep going with each other.
Maybe I'll start, Kathleen. I think one of the things that's important for different parts of the country, I mean, Zach's in Texas and Bryce is in Kentucky. I mean, you think about what it takes to support entrepreneurs in different regions. Bill's in New York. There's a lot going on there. We just heard Steve talk about where so much venture capital is concentrated in mainly 3 geographies. I think there's several aspects to this, but it's important to think about what it takes to help entrepreneurs be successful. Capital is one part of it, but it is an ecosystem that is important. So you got to have talented people to work at those companies. You need to have great ideas coming out, like it sounds like was talked about in previous days. My apologies for not being able to join all of the previous sessions, but you've got to have great universities. You've got to have great tech transfer, commercialization. You got to have people focused on the idea to support this very risky endeavor. Most entrepreneurs fail, right? So how can we help the entrepreneurs who are spread out all over the country? What can we do to help them? It's not just the idea and just the capital. It's a lot of things that go into an ecosystem to help them be successful.
And Bobby, I'd add to that observation, which is spot on, that there have been some natural hubs where the talent has been aggregated. And because of, and in particular in my field, in healthcare and life sciences, because the failure rate is so high, when you have an ecosystem that has optionality, that doesn't require you to have to displace your entire family in order to find an opportunity similar to one that you pursued, that is a major factor. It's been a major driver for why in life sciences there's still only 2 or 3 major hubs. And ironically, when companies get aggregated, some of those hubs go away. So we've seen San Diego emerge and then contract. We've seen Baltimore emerge and contract. So there's an ecosystem that has to be able to replenish itself, and that ecosystem requires that critical mass.
Yeah, one point I'd like to add is, in addition to the ingredients of an ecosystem that Bobby and Bill just named, culture is a big part of it. Specifically risk-taking and collaborative culture. Steve talked about this a little bit. And I don't just mean risk-taking on the part of the entrepreneur, although that's critical. A lot of the corporates who oftentimes serve as the early customers to a lot of startups, they have to embrace a risk-taking and innovative culture and not have a, not invented here mentality or, their technology isn't as good as our technology sort of mindset, right? And embrace the opportunity that supporting some of these startups might actually help transform and future-proof their businesses.
So let me throw in though, think about the Nest thermostat. Why wasn't the Nest thermostat brought to market by Honeywell or by Johnson Controls or by Emerson Electric, all these companies in the middle of the country that make thermostats? And instead, it was a guy in California who, by the way, went to University of Michigan, who did it. I think it was the VCs. I think it was what the VCs helped that guy do with the company. But what do you guys think? Bryce, you should talk because you haven't yet.
Yeah, and I think I would just add to the previous conversation as well. I think one of the things in Mid-America that we've seen is when we talk about supporting startups with an ecosystem, it needs to also encompass an ecosystem of the capital itself. Only 1% of companies ever take venture. 83% figure out some other form of capital to scale and grow their business. The example Steve used of MailChimp, one of the largest private exits from Atlanta across the country, was a bootstrap. And so we've got to get creative as we think about ecosystems around the structure of capital and not assume that entrepreneurs only take venture and venture is the only form of capital to help them grow and scale. But I think to your question on Nest, I think you're spot on. I think the coast and Silicon Valley specifically have figured out this culture of failure that is permissible. There's a permission to fail. And when I do ecosystem tours, when I'm visiting Miami or other things, I'm sure Steve would say the same with the rise of the rest. There's a reticence to failure in a lot of communities because of what that means. And I think the communities that have figured out how to embrace failure as a part of the journey, as a part of the learning experience of these entrepreneurs, and I think that's where venture capitalists come in and really support that, you see success. And so I think that's one of the things as ecosystems that I think Zach was spot on with is a culture, and a culture that permits failure.
How do you change a culture then? I mean, that's such a squishy thing to talk about.
Well, one thing I think you could do is help folks in different regions understand that writ large, the United States does embrace failure far better than many other cultures. And it's one of the reasons we have had far more innovation come out of the US than our competitors around the world. So it's helping these local regions get what Zach and Bryce are saying. It's like, it's okay to fail. It's a stepping stone towards success. But let me go back to your question, Kathleen, talking about an example of somebody that graduated Michigan. If we had more venture capital investors in Michigan, which I hope we can help create, which takes capital, it takes access to education and information about venture investing. That's why we created VC University over the last couple of years. We have people that now we've democratized access to information and education about venture investing, and we want to see that expanded. We want to see more underrepresented minorities, see more women start funds and be located closer to where entrepreneurs are. And if there had been more VCs and more capital that had been formed in Michigan, perhaps the person you talk about wouldn't have left, wouldn't have had to go somewhere else, right? So I agree with the premise of your question that when entrepreneurs and capital are connected, great things can happen. Now, looking at the question from the standpoint of Honeywell or other companies, that's another great thing about the entrepreneurial ecosystem, to continue to disrupt, to continue to compete against incumbent players, to keep them sharp on their edge and understand that you have to continue to up your game if you're going to be successful over a long period of time. It's why at NVCA, we have many corporate venture members. A lot of corporations have a venture arm, and they make investments into companies, sometimes to see what's out there that might be disruptive to them. Sometimes it's just to stay on the cutting edge of what is happening. And I think that's also a healthy part of a business environment and ecosystem.
In a way, you're making an argument that having more VCs in your community will drive some of this disruption. Do you guys agree with that?
Well, I think having more VCs in different areas will help. Entrepreneurs are everywhere. Let's just take it on face value, unless somebody wants to argue that entrepreneurs are in every state and every congressional district. Those are the folks I talk to. And so you have to make sure that they have access to the capital they need to take the chance. They may fail, but they may help them come to success to realize a dream, a new product or a new service.
And Bobby, I think you hit the nail on the head too with around education. In Louisville, we see that a lot. There are people that have the financial capacity to invest, but they lack the sophistication to do it. And so therefore, if I don't understand it, and I'm going to look like an idiot if I walk into that room and I don't know what I'm talking about, it's easier for me to leave my money on Wall Street. And so how do we get more of these executives working at major corporations to get personally involved because they have the financial capacity to do it? And they need the support to get in the game. And we need to be communities that encourage that.
And how do we get our pension funds to stop sending money, all their alternative investments to the coasts, and put some of it? I mean, it's a chicken and egg thing, right?
It is. Well, and even the funds that exist in these communities. In Louisville, Kentucky alone, there's over almost $2 billion under management in the philanthropic community. And I will tell you, none of it is doing venture investing. And so that there's a problem when we have these communities that have the financial capacity to support ecosystems and the entrepreneurs that are creating jobs. We've got to start asking ourselves of these pension funds and these endowments, what are you doing with the 95% that you're investing for returns only to support the communities that you care about and the communities that you're supposed to be supporting?
So Bobby, you're good at getting politicians to do stuff. How do you get those pension fund people to do it?
Well, it's a great question. I guess if I knew how to do that, I might be in a different line of work. I think it's not only the LPs. Really, what Bryce says is really important. Actually, Steve Case and I have had this conversation in the past. Look at family offices. Look at wealth that's in every state. And, most of those entrepreneurs at one time that created wealth, maybe it's in real estate, maybe it's in oil and gas or something. There is this dichotomy. They'll have a family office. They'll make investments for a return. Get it. They'll also give lots of philanthropic support to their region, their city. They care about it, to their state. And I wish we could find a way to help them understand that, hey, there's actually a hybrid here. You could really help your state by providing some of the support that you like helping your state with in a way that's focused on helping support the entrepreneurs that could come up with the next great entire industry, not just company, that could support your region. So can you think about philanthropy and investment returns in some hybrid way? I think we have to have that conversation so that the capital that is out there, in addition to the LPs, the pension funds, stuff like that, recognize the opportunity they have in their backyard.
So Bill, you're in New York. What do you see when you look at healthcare deals? Why are the deals in Boston better than the deals in Chicago?
Well, there's a number of reasons, starting with the ability for those entities that come out of the Cambridge community to attract critical dollars, large Series A's, in order to fund the very expensive platforms that they're establishing. So number one, you have the attention of the venture community. And number two, you have, and they're immediately surrounding you. Number two, you have a very talented pool of discoverers as a substrate in academia. So it's a very rich area for discovery. And because it's all embraced in a community of professionals that are very involved in drug discovery, you have the ability to very easily recruit talent. It's not inexpensive, but you can recruit and retain the appropriate talent there. So you're bringing great ideas from great institutions that are well supported by venture capital, that have the access to the human resource that is going to deliver the execution. But that model, just because good companies come from the Boston area, doesn't mean that that's the only place to find good ideas. And I think some of the lessons that we've learned that Steve was touching on earlier is that we've had technologies, and we've also had the virtualness of, say, drug discovery. So the idea that an institution in the Midwest, let's just call out for a moment Notre Dame. Notre Dame has an excellent biochemistry department, and they have some of the best expertise in a particular type of a neurodegenerative disease that's in the pediatric setting. Those ideas will get recognized very quickly. Now, the difficulty for the community surrounding the university in that setting is that there isn't much of an infrastructure to support advancing those ideas. But because of this virtualness that we now have, we can engage our thought leaders virtually, in person, or using technology. But more importantly, we can deploy a development plan across a variety of the best places, CROs that are capable of taking on the individual steps that are required, at least in my field, in drug discovery and development. So we're getting more ideas, and I try to, and it kind of goes to Bobby's point. I want to make sure that I'm not confusing regional economic development with entrepreneurship and company creation. The ideas will come from across the country, but where they're deployed is going to really depend on where the human resources and the expertise exists. So that may be in New Jersey, and it may be in upstate New York, or it may be in Chicago.
And I think one thing that we've alluded to but haven't really focused on that contributes to all of this is density, right? Like one success breeds a second success, which breeds a third and a fourth, and these things happen exponentially. So, Boston's a great example of, healthcare density, but, there are, emerging examples of that same type of success in other areas. To give a shout out to Wisconsin, all the work that was discovered around vitamin D in Madison. In Ohio, in Columbus, there's a lot of advancement taking place in gene therapy, a lot of success around that. So as you look around the country, people, talent and capital tend to coalesce around density of competitive advantage, and then you grow that competitive advantage in whatever sector that is in that location. I think an interesting question would be that in this new world of working remotely and being able to do so many things virtually, can the country become one big dense area itself? Can you simply have density of network and that be sufficient because capital is becoming increasingly fluid? Like, I think that might be something worth exploring and is probably critical in order to continue to drive inclusion in this space.
I was talking recently with a coastal VC. We were talking about quantum, and I was asking him about Chicago has this Chicago Quantum Exchange, which is University of Chicago led, a bunch of Midwest universities. And I said to him, what do you think of that? And he said, well, I don't think anything of it. If it were in Boston, I would know what all the use cases were. I'd know that it would be life sciences use cases. I'd know the people who'd be working on them. I'd know what the Midwest is one big blob to me. I don't know what anybody's good at anywhere. What do you guys think of that?
I think there's also, I think that's, well, on one hand, it's offensive and somewhat of an ignorant comment because it's someone that's not really done any research. But on the other hand, I think if, for Louisville and in Kentucky and Indiana, one of the things we looked around is, it's basic, asset mapping. Like in our region, if you think about, like, we've got to get more specific around how we define our strengths as well. So like, I think Governor Beshear right now is big on ag tech and making us innovative around ag tech. We actually had the first in the nation accelerator on agriculture 4 years running. And I think one of the reasons it's not running anymore is because there was a lack of focus around what within agriculture are we specifically doing. But what we have is we have 2 of the top 10 engineering schools in the country in our region, Purdue and Rose-Hulman. In Kentucky alone, we have 83% of farms are still small shareholder farms because of tobacco and the ability for a small farmer to make a good wage. And when you compare that to India, where 80% of farms are still small shareholder farms, how do we actually make it more successful for businesses for these businesses, these small farms to be successful? And if we can do it in Kentucky, we can do it in India. And so then
I just want to push back on that a little. What I see when I look across the middle of the country, I can think of 2 areas that I think have really defined themselves. One is Pittsburgh with Carnegie Mellon and with robotics, and the proof of that is Uber putting a big facility there, a lot of institutes springing up, and the other is Wichita with that Aerospace Institute, and you can see that all the big aerospace companies are coming because of it. But what else is defined in the middle of the country? Because you define it by having all that stuff coming around it, right?
Well, you do, but I think you've got to start, like, so for instance, we've been doing a lot of work around agriculture for a long time. And what you're starting to see are companies that are co-locating because they see those asset values. So for example, in Kentucky, Memphis is right across the border and they have the FedEx port. In Louisville, we've got the UPS World Port. And in Northern Kentucky, we've got the Amazon port. So when you think about—
that seems like logistics, not ag tech.
So then if we're thinking about agriculture and we want to narrow and really refine it, it's logistics, supply chain management related to agriculture. So that's why App Harvest, for example, that just IPO'd and is a Rise of the Rest portfolio company, is in Moorhead, Kentucky, building massive greenhouses. So I think you start to see that. St. Louis, you see Monsanto, and even in Minnesota, you start to see some food densities or seed derivation densities. So I think you've got to figure out what are those assets within the region and how do we build density around that? How do we leverage that so that we can create the Wichitas and attract some of that?
Anyone else know of it? I mean, that's part of the problem is it's not very defined what those assets are in the middle of the country, right?
Well, I think generally speaking, nationally, this is a relatively new topic, right? People have to understand Silicon Valley is 50 some odd years old. And a lot of other regions of the country are just awakening to the possibility of high growth entrepreneurship and technology as something it should embrace in order to transform its local economy. And so people are increasingly saying, yeah, why don't we have that? Why don't we do this? And so as they learn, I think they then go through the exercise of mapping their ecosystems and their geographies and so on and so forth. So one of the things I'm trying to take advantage of with my new fund here in Texas is preaching that same message to organizations like the Texas Medical Center, right? That's 61 different institutions that include places like MD Anderson, Texas Women's, Texas Children's, and others, and preach that same message like, look, all this medical and life science talent is in the same place. We just need to start having a more coordinated conversation about the things we want to achieve, and success will follow. So, it's simply a matter of bringing innovation, in the terms that we understand the people who follow venture capital to the rest of the world. Because also remember that even when Silicon Valley was on the rise, it was still a fairly elitist and esoteric and little known thing, right? Like it's become more popular through the rise of companies like Google and Facebook that have become ubiquitous in our everyday lives. But before that, all the major successes like Genentech, when it first happened, were like all off the radar, and now no one's front page news.
You could make an argument that Silicon Valley was has been built on consumer SaaS businesses, Facebook and Google, et cetera, and that now that has been exploited in the nicest way possible, it's time to take those tools and apply them to health and to industry, et cetera. And that maybe there's a tension going on, like who's gonna own that? Is the industrial heartland going to drive the application of these new tools to industry, or is Silicon Valley going to do it? Do you guys see that playing out, or do you have opinions about it?
In short, yes. I'll speak on that because I saw a lot of this when I was still in Ohio. So the thought is that a lot of that enterprise SaaS related technology gets adopted and then transforms all of our legacy industries, right? Advanced manufacturing and logistics and all the things that the heartland is known to be good at, ag tech, et cetera. Because now a pathway has been defined by those who are more specialized in software, as that then permeates the people who are more sophisticated in agriculture and agronomy. Now they can use those tools to advance their own industries. And so I think it's simply a matter of adoption and growth and expanded understanding.
But it's more complicated. It's more complicated to apply those tools to agriculture than to consumer business models. And who does it? Does the agriculture industry in the middle of the country do it, or do the tech people on the coast do it? That's a fun battle, right?
I think those industries are increasingly overlapping. I think people who are getting PhDs in agronomy are learning about various types of software and artificial intelligence. It's increasingly a part of their curriculum. People who have become software engineers but grew up on the farm in Indiana are going back home and partnering with their friend who stayed on the family farm, and they're forming companies together. Like, I think those are the trends that we have seen, or there are proof points of those things happening, and they just need to happen enough that they become trends and then become more obvious to people who maybe aren't studying these things on a daily basis.
Kathleen, there's a great example in the field of life sciences, the discovery in and around of CRISPR editing, the ability to manipulate genes. These discoveries early on, the main hubs of those discoveries were the West Coast, Berkeley, and the East Coast, the MIT Harvard community. But that technology has applications across all types of biology, and where it's being applied in terms of agriculture, those applications are occurring outside of Berkeley, not in Berkeley, not in the Cambridge community, but in the Midlands. So this is where conventional ag intersects with this, emerging life sciences field, and that's kind of the expansion that naturally occurs. So we may see just new hubs come up, similar to what was described earlier in Memphis and across the river, where hubs naturally occur.
And if I could, I think when Zach was talking about, the planning around, it takes time. Silicon Valley is around for 50 years. I think there's a danger a lot of times. There's an ideological shift that has to occur, a philosophical discussion around, do we want to be Silicon Valley? I think some people do, ooh, that's cool. We need the next tech hub. The danger of that direction is you get the Silicon Valley, also, which has all of its problems. You kind of joked that that they've created a lot of problems in the Bay Area, and so do we want that in our community? That's a conversation I hear in Mid-America. Do we actually really want to replicate Silicon Valley? And then the other side of it is, should we replicate Silicon Valley? Is the other question. And so I think we've got to get past that. But then what Zach was saying around how do we build this? We've got to actually look around and say, what assets do we have? And then how do we take those assets and build the type of ecosystem, and what's the capital to support that ecosystem that's good and works for us in the market that we're trying to impact. And so I think the danger is cookie cuttering Silicon Valley and saying that, well, they're doing it there and let's just chase that. The danger on the policy side and at the state level, for example, in Kentucky, the only type of venture dollars that can go to companies is traditional equity. And it's on the same terms that you see in the Bay Area, and they want the same return as a Facebook or a Google. And that just doesn't happen here. And so we've got to have policy changes at the state level and the federal level to really allow for some innovation and capital to support these entrepreneurs and their growth.
Bobby, your bailiwick, what kind of changes?
Well, I was loving listening to the responses here, and what it reminds me of is, to me, don't box yourself in, right? I mean, understand what you do really well. I mean, heard the examples about being close to ports. I know I'm from Arkansas. Northwest Arkansas is known for supply chain. You've got Walmart headquartered there. You got Tyson's Food headquartered there. You got JB Hunt Trucking Company headquartered there. So they, my alma mater turns out a lot of supply chain management experts. And certainly there can be innovation there, but don't let that preclude you from just thinking about the ingredients of a healthy entrepreneurial ecosystem and imagine that something else could be created that you will be known for. You don't have to be stuck for what you've always been known for, whether it's agriculture, whether it's something else. If you get the right ideas, if you get the spirit of entrepreneurship in the right place, if you have capital formed, if you have investors ready to deploy capital, I mean, a lot of great things can happen. And what I hope is it's that general sense of we need a healthy entrepreneurial ecosystem everywhere across the country, and let's see what happens. That to me is what we have to kind of think about and adopt. And it's a lot of different places. So economic development today shouldn't be what economic development was a decade ago. Shouldn't be about, I'm going to go recruit the new Toyota plant to come build cars here and get 1,000 jobs or whatever. It needs to be thinking about what can we do as a region? What can we do to help foster this entrepreneurial spirit? How can we bring people together that care about this? What do they need to support them? From a policy standpoint, you get into a lot of questions, either the state or the federal level. You think about, well, we need to be talking about benefits and being able to have people be able to change jobs and take a chance somewhere else. In universities, we need to be thinking about, well, why shouldn't we be encouraging professors to leave their comfortable professorship and go try to help create a company here? But if they fail, which there's a high likelihood, they perhaps can come back. Let's look at tenure. Let's look at conflicts of interest. Let's look at all of the things that could be holding back an entrepreneurial spirit in different regions and in different aspects of what that ecosystem and all the players in it need to be thinking about.
So who should be leading that discussion? What I see in the middle of the country a lot is the fake people lead the discussion, and the entrepreneurs and the successful entrepreneurs and VCs, no one listens to them. So how do you have the right, I mean, there's a lot of innovation theater around all this. How do you get the right discussion going and drive the right intention?
You have CSIS put on nice panels for a few days and you have this conversation and get more people to pay attention to it. I look, if it were easy, it would have already been done, right? It is difficult. It is tough. It is a lot of people having to rethink kind of their role in what it takes. It's getting a lot of people to buy into a vision. It's governors, it's state legislators, it's federal policymakers. I mean, I'll give you an example. There's a bill that was signed into law earlier this year. It's called SSBCI. There's about to be billions of dollars sent out to states. And right now, Treasury is trying to write rules. We would have hoped that those would have already been out. Then states are going to make applications on what they will do with this block granted money from the federal government. And in many cases, to get the type of return that the program's looking at, it's going to require venture type equity investing. And that's going to be a shot in the arm. We've been talking about, capital formation in lots of states. A lot of capital is coming from the federal government. And this was done back in the Obama years, but it was less than 2 billion. Now the overall is 10 billion. It's already been approved. And so, here comes some dollars pretty soon, starting next year. And so states and governors and economic development commissions and others are going to have to think about, how do we deploy this in the best way? How can this help our entrepreneurial ecosystem here in our state get more developed?
So I've heard a lot of the preliminary discussions about this, and I've seen the way a lot of states have deployed that money in the past. I realize I'm asking a certain audience, but what is the best way for states to deal with that money?
I mean, for me, it's easy. It's making sure that it has a venture capital type equity-based model to deploy. There are also provisions in there that are have some reserves for underrepresented minorities being able to get in here. So we need more check writers.
Well, so one of the questions there is, there are a lot of variations of venture capital model, and is it better? In Wisconsin, for example, we have something called the Badger Fund of Funds, which was one of our successful VCs in the state had this vision of, we need to grow our own venture capitalists. So he started this thing. He got 25 million from the state. There are now 5 new funds with new managers. They, in their 30s and 40s, came from, one was recruited from Wall Street, one was working at a money management firm here, et cetera. Should states think about that? Do they need to grow their own VCs? Should they invest in VC funds that'll put an office in the state? There are a lot of ways to do it. And there are a lot of state bureaucrats who don't know much about venture capital.
The answer is all the above. And we're actually, us and the Angel Capital Association are going to be participating in a webinar for state folks just next week to help them understand and to learn. There were a lot of learnings from the original SSBCI program from years ago. There was a significant report written at the end of it. So there's a lot for folks to learn about what worked and what didn't work.
And where can people in states learn about that? How do they get that information to attend?
I don't have the answer off the top of my head, but I will certainly look for that.
Awesome. Let's switch to, I know one of the other things we all wanted to talk about is kind of creative ways to fund companies. And, there's traditional venture capital, but you've pointed out very few companies get that. Bryce, why don't you start? You've got a partnership with Wefunder. Why don't you tell us about that?
Yeah, so Wefunder, Steve mentioned it, the Jobs Act. And so the Jobs Act kind of loosened what was permissible for investment into startups. And initially, you can invest up to $1 million through crowdfunded equity. So platforms like Wefunder or Republic kind of have popped up. Recently in April, though, there was an adjustment that now startups can raise up to $5 million through crowdfunded equity, which is not insignificant. I mean, $1 million is still kind of like an idea stage company, maybe no revenue. $5 million is pretty significant. And we've already seen really interesting things like Mercury, which closed on a Series B, $100 million led by Andreessen Horowitz, that opened up $5 million on Wefunder to allow their customers to invest. And so it's an interesting way to kind of, everybody wins. The community can invest, the startup's able to access capital. And so it democratizes access to capital, and it democratizes the ability for people to get involved in the game of investing. And so Mercury was oversubscribed. They raised $7 million on their $5 million target in 1 hour, as one example. And so what we've done in Louisville is we try to take some of that, and we've created the first in the nation match fund to try to incentivize adoption of new ways of deploying capital. And so if you're raising on Wefunder, we'll match your first $20,000 on whatever terms you set as an entrepreneur. And now we went from 0 companies aware of or using crowdfunded equity to now 6 in the last 12 months have raised.
Who's we? Who's the we that's matching?
We raised a regional investment fund that kind of it's a strategy that's across the spectrum, everything from First Dollar Initiative for Black and Brown founders in Louisville to patient debt financing for small businesses, all the way up through to traditional equity. It's about a $15 million regional strategy called Render Capital. And so trying to look at ways to bring different types of capital to the table and incentivize other partners. How do we get banks re-engaged that are not, have historically kind of retracted from startups? Because I think that's the other thing is entrepreneurs start at different places. They don't just build a company and go out and raise venture. An example, there's a company in Louisville, their first dollar was a Kiva loan at 0%. And they literally last year, in the last 12 months, closed on $3 million of venture. And so I think as we think about building thriving whole entrepreneurial ecosystems, we've got to look at kind of the continuum of capital to support the growth.
So let me push back a little, not because I disagree with you, just because
Sure.
for the sake of argument, this Badger funds that I mentioned is very investor friendly. And that's the complaint that a lot of the entrepreneurs have, that, you know, it's focused completely on ROI, and investors, you know, have a really good shot at great returns. And that will probably draw in more investors, right? The kinds of things you're talking about might not be as focused on ROI. And then what does that do to your ecosystem? I mean, isn't this all about making money in the end for the people you want to put money in?
I think it's starting with what's the expectation of capital. And so within Render as a strategy, we have multiple different vehicles that have different expectations of capital. And so we try to be as honest as possible about what the goal of that capital is, and then the type of entrepreneur or type of company that's going to support. And so I think as an ecosystem, we've got to then build a pretty robust stack of capital to support entrepreneurs. And that's going to include below market lending that banks aren't doing. And so how do we create that pool of capital? That might be a program related investment from one of these endowments in the region that, you know, 1% or even 0% return is better than a charitable contribution that gets them no return.
So is
the negative return.
Isn't a concern that, like, I was looking the other day at Renaissance funds in Michigan, which, you know, get corporations to all put money in, and then they run demo days and bring in outside funds. So they're on their 4th fund. They just raised their 4th fund. Their first was 40 million. They kept going up to, I think, 81. And now the most recent one was 79. And, you know, I used to be a reporter. Whenever you see that a fund doesn't raise as much the next time, you figure they have bad performance. So don't you run the risk of these investors kind of, you know, losing them by attrition over time if you don't have great returns?
Yeah, and that's where I think it becomes somewhat of a marketing challenge, to be honest, because Render Capital is multiple types of capital within one office, so to speak. And so what we're working on right now is how do we actually get really thoughtful about articulating, this is our traditional equity fund within our regional strategy. This is our below market lending fund. This is our venture debt strategy. And so then we can go and have, you know, conversations that are apples to apples with both the investors that are open to those types of returns and then the entrepreneurs. And so I think, you know, the pie in the sky would be that we could create a strategy that's going to support an entrepreneur across their entire journey. And that's just not, that's not possible because the blended return is something that's not going to attract the capital to grow and scale.
So what do you guys think of this? Can you build an ecosystem long-term with those kind of strategies?
I think the part of Bryce's point, it depends upon how honest you are about setting the expectations. And so this is one of the topics that often comes up when we talk about being inclusive in venture capital and tech entrepreneurship, and including women, including minorities. Suddenly the conversation shifts like, oh, well, it's more like philanthropy, which is kind of giving everybody a chance. It's like, well, no, like, certain communities, certain groups of people have been excluded from capital and other, opportunities purely based on, not being in a certain circle or not going to Stanford or whatever the case may be. And what the data has shown overwhelmingly is that when these people with the same grit, same educational opportunities, et cetera, get an equal shot to start a business, grow a business, because they're funded and they're supported by their ecosystem, they have the same, if not greater success, right? We know that more diverse management teams yield greater results, specifically due to the fact that they've got women on them and minorities on them, et cetera, et cetera. So managing the expectations as to, and making sure that you're still investing in people who have solid business plans and making sure that they have training to develop a good business plan, or whatever the case may be, that's what underpins the success or de-risk the investment opportunity for your capital. And so as long as you're going in with that explicit strategy that you're expecting 10% returns as opposed to 30% returns, and I think everything works out.
So just to pick at this, because that's my background, picking at things. Yeah, okay, but is that seems different to me from a strategy to win, a strategy to like build deep tech startups and have a focus, like we were talking about earlier, that competes globally. I'm not saying that's a bad thing, doing all that stuff. I'm just saying if we want the middle of the country to compete globally, doesn't it have to be like ROI focused and figuring out where the strengths are and all that stuff?
Well, everyone's got a different return profile that they're looking for, right? Like real estate doesn't expect the same as venture capital, which doesn't expect the same as a bank. So, I think you get in where you're fitting and you stay in your lane. And as long as, if you decide my lane is going to be venture capital and I want genuine venture returns, then that's what you focus on. But you still make sure that you are giving all of the good ideas within that bucket of opportunity a fair shake to earn those dollars.
Kathleen, let me pick up on something that I think is inherent in your question. And you're talking about the terms, and you said something earlier about kind of investor-friendly terms and things like that. I will say that I have witnessed a conversation within our industry. People that were on the coast that actually ended up moving to the middle of the country and raising funds and investing there brought term sheets that they were used to on the coast. And on the coast, it's such a competitive environment. Many times you have to have very founder portfolio company friendly terms in order to win the deal, right? To get into the entrepreneur, the idea that you really want to get into. And I've had this question to some of the folks I meet with in the middle of the country, and they're mad that, I wish we had more capital and all this stuff. And I said, well, have you looked at yourself in the mirror? Are you complain to me on one hand that entrepreneurs run to the coast to get money, yet isn't it evident that sometimes your terms are less founder friendly than the ones that you're mad that they're going to? So you have to sort of be honest with yourself about some of those terms. And I think that's a healthy conversation to have. At the same time, I get your point that at the end of the day, if you're going to continue to have capital come in, there has to be some expectation. And I think what Bryce and Zach are talking about is, as long as you're transparent about what those expectations are and understand, kind of what we can do. I mean, I bet if Steve were still on this, he would talk about, and I think he did mention in talking to John, that there is a misunderstanding sometimes that there aren't great returns in companies off the coast, because the cost for those companies tends to be a lot lower for the talent and other stuff. And so, I think there's a lot of misperceptions and biases that are built in that, we all need to do a better job of kind of rooting out and helping with data, helping with understanding. We now, just in terms of some of the stuff Zach was talking about for Black and Brown and others, we're getting a lot more data now with our human capital survey to understand what's happening in the industry. And we've done this now every 2 years for the last 6 years. And we're making progress in some areas and we're not making progress in other areas. One of the learnings from this has been that when firms are intentional about being more diverse and about recognizing the opportunity to have diverse teams, making better decisions, having better financial outcomes, then the data follows. And so intentionality is very important here by everybody in the ecosystem.
So there's one of these Badger funds. I'm in Milwaukee, and one of them that recently closed is run by an African-American woman, engineering background, used to be at a big company. And she was able to raise money from the Greater Milwaukee Foundation, which has never put money into venture before. So it's interesting. I think part of it was that this was this diversity opportunity, but she's totally ROI focused. So maybe that's the best of both worlds. I don't know. My frustration in this discussion is, these big pension funds and all this money in the middle of the country for the last 10 years, I'd say there have been discussions about putting money into different types of vehicles, and they still don't do it. They still just go to the coasts where the returns are the best. So how can you argue that? It seems like that's what they go after, those returns. So don't you have to have them in the middle of the country to get those investors? Or can you change their minds somehow?
I think you do have to have it, but I think it's a false assumption that you can't get great returns outside the coast.
Kathleen, we touched earlier on the entrepreneurial risk-taking culture. And one possible solution has been, and we're trying this in some of our academic collaborations, reducing the cost of failure. So with each idea, and you think about what universities do well, at least in life sciences and human health, they identify novel biology. So novel is high risk. It's novel. It's just discovered. We don't really know what it means. Or they discover better ways, different ways, novel ways to target known targets, validated targets. Sounds less risky, but it's just the same risk. These are all still very high risk. If you look statistically, at this stage in the university setting, if this were advanced into some kind of a drugging activity, it's about a 2% chance at that stage that it's going to actually work. So if we think about building companies and the cost of building all this stuff, we have a lot of expense with a lot of failure. What if we thought about ways that we could reduce the cost of failure? And there's no doubt the universities have lots of discovery substrate, but if we developed a mechanism that allowed us to exploit those discoveries and do it in a highly leveraged way, so you build and you just constantly bring it through this professional mechanism that can de-risk the program to the point where it can now stand on its own. The odds of it failure goes from 98% to 60%. We'll just imagine that. These are major steps that we have within our possession today to help improve the opportunities for wherever discoveries occur. Can we reduce that cost of failure?
It's a great point. I think to piggyback, the other thing is I think it's good to ask hard questions and say, could we get better at this? I think some of the limitations, I think we forget that venture capital is relatively new. And so how do we begin to question, like, are the term sheets exclusive? How do we reimagine what we think about in structuring this? And to what Bobby was saying, like just the transparency between the investors and the entrepreneurs so that we all kind of are going into it eyes wide open. But I also think we've got to ask some societal questions around the issues of private debt in America and the impacts on regular people's ability to start and take risk because of student debt or other private debt that's inhibiting their ability to take that risk, or childcare. The age of entrepreneurs is going up. And so what are we doing to support entrepreneurs that might have children at home and providing these services, early childhood education? All of those are part of the story. And those are challenges that entrepreneurs face as they're trying to build and scale.
So I nominate Bryce to be the middle of the country engineer to improve on Silicon Valley. Are you up for the challenge, Bryce?
Sure. I need your help.
Well, you can form a team. You just have to. We had a really interesting question in the Q&A. It's from Lisa Lorenzen. And she is actually, when we were talking about areas of expertise in the Midwest, she was talking about the animal health corridor in the Kansas City area. But one of the things she said is there's a lot going on in the Midwest, but it's hard to get anyone to listen, even when you talk. What do you think?
I couldn't agree more. I mean, there's so much noise out there, and there's you got to try to break through. And I get to hear of examples every day from our members and some amazing opportunities. We've heard several on this panel today and from the conversation with Steve Case about what's happening in different parts of the country. And it does need more publicity. It does need more recognition, because I think that's when you start to get these players of this ecosystem that you're trying to build to see the opportunity. They have to be able to see something. A lot of people have to be able to see something. They can't just hear about it. They have to see the success of something going on in their region, which help them imagine what could be. And so many players have to be able to see that, to create that environment so that it just breeds more and more success. That's part of the reason why the 3 epicenters of venture continue to do well, because they have so many people that can see it on a day-to-day basis from their neighbors, from their friends, from their local press. And it just feeds on itself. And you need that, positive spiral of innovation and encouragement of each player in these ecosystems.
I think you could argue those centers have become almost national media markets too, and we don't have those in the middle of the country.
You do, but I really, a good story is still a good story. And I think there are a lot of really good stories out there, and we need help telling them.
Do you think we should make a rule that every coastal panel that happens should have a middle of the country person on it? And should we call Anderson Cooper and ask him to kind of, switch it up a little bit?
Sure.
Who's going to make the call? Bryce?
I'm always in D, all of the above, right? I mean, because there's no one answer to a lot of these challenges that we're all sort of identifying, and we're thinking and talking about what could help these regions do better. I think it's all got to be all of the above. And I think, we don't know what the dots that are going to connect to have one region stand out more than it is today. Let's try it all.
So one of the reasons we're talking, go ahead.
I was just it's a great question. And the only thing I was going to throw out is, because there's been a void, I am also super impressed by just the scrappiness of people in the Midwest to just kind of try to fill that void. There's a Middle Tech podcast in Kentucky that is really growing steam. And so some new media outlets, Elizabeth McBride, who's been featured in Wall Street Journal and New York Times and Forbes, she just started a new publication called The Times of Entrepreneurship to really highlight what's happening in mid-America. So I think some of it is, how do we get backing behind some of those efforts to really elevate these stories, so that maybe those stories then are reposted in the national media markets in a way that really does start to do that.
I was a reporter at the Milwaukee Journal Sentinel, and my sister lives in Chicago. And one day she called me and she said, "Oh, John Smith from Dow Jones says hi." And I said, "Who's that?" She said, "Oh, he said, I saw him at a party. He says he knows you." I said, "I don't know that guy." Well, it turned out what those people do is they sit and read local media outlets. So he knew me because he was reading all my stories. So you're right. You get those stories out and they get picked up nationally. Yeah. I'm just looking at our Q&A and, Research Triangle, there's Jeffrey Alexander, who's with the Research Triangle Institute, is talking about, how long it took to grow Research Triangle, and can you build new centers, he's asking, in less than 2 decades?
Let's hope so.
Let me throw in, one of the reasons we're doing this is because the federal government is considering putting big amounts of money into, is it 10 now regional centers, $1 billion each, maybe it was, Bobby, you probably know. What would you do if you, Louisville, I think, is interested in this. Louisville probably can't absorb $1 billion. What would you do? What are your recommendations for these centers if they get this $1 billion? What are some of your best ideas for how they should go about managing it? I should say Madison, Wisconsin is another area in my neck of the woods trying to get one of these. But none of us have Chuck Schumers, right?
Yeah. I think Louisville's interesting. One of the things I think would be really interesting for Louisville is trying to be a first in the nation model for a bi-state cooperation. You look at the data, and where there's a bi-state zone, business doesn't see state boundaries. There's 1.3 million people in Louisville MSA. 30% of that lives in Southern Indiana. Southern Indiana's 3 townships that together would be the 3rd largest municipality in the state of Indiana. And yet we get ignored by Indianapolis because we're not Indianapolis, we're not West Lafayette, we're not Notre Dame. And so they just kind of hand it off to Kentucky. Well, that creates a lot of problems when it comes to innovation and support through investment. And you can look at the latest data in Indiana, for example, not a single dollar through their state funded investment funds went to Southern Indiana. And it's because they got enough density in Indianapolis. And so I think for Louisville, a lot of that money should be focused on building a bi-state kind of regional, truly regional strategy that is independent of state boundaries, because we're better together. Many of the strengths that Kentucky has related to agriculture and logistics and supply chain exist in Indiana as well. And so how can we look at the assets between those 2 states, or 3 states if we lumped in Ohio, and come up with a really interesting, innovative solution?
I have a growing appreciation for Bobby's political abilities. Bobby, how would you get 3 states to work together?
Well, I guess it depends on the states, right?
Could we enroll you in trying to make that happen? Would you help us?
Yeah. Well, you got to talk to my board and see if they would, let me use my non-free time to do that.
I think Bryce is willing to talk to your board.
Okay. I do think there's a lot to that. We do have to think kind of regionally, and as you said, if Endless Frontier becomes law and these regional tech centers come together. Now, some of it, if you look at the legislation, a lot of it has a focus around areas that we want to see the U.S. lead in. So it's not all just geography focused. Sometimes some of it speaks to we need to understand AI. We need to understand machine learning. We need to understand quantum computing. We need to understand these things. And that is going to take, a coalition of many institutions and other players that are on the leading edge of the different ideas to work together. Sometimes it could be regionally and geographically. Sometimes it could be from an expertise standpoint and where the expertise is and how we can use this as a way to help the country kind of lead in so many areas.
You raise a great point. That when you look at China, what they do is they say, this city is doing AI, and then all the AI ends up in that city, and we don't, have that kind of.
We don't force our cities to just spring up and stuff like they do in China. You're right. So it's harder when you don't have a party in control of an entire country. So it's going to be harder. I do believe that it's possible. I think you already see, consortiums of leading universities in different areas. Bill's talked a lot about life sciences. I mean, there's a lot of working together among institutions in different areas with CRISPR, others. I mean, there's a lot that happens, and a lot is going to need to happen, and a lot is going to have a great opportunity if the Endless Frontier Act does become law. It's got a different name now, but that's what we're hoping for.
Well, and let's remember, two of the original sponsors on the Endless Frontier Act were Representative Gallagher, our Wisconsin, no relation, and Senator Young from Indiana. So there are Midwestern fingerprints on it, right?
Absolutely.
Bill, you're trying to kind of address that by this, I don't know how to, almost putting together companies virtually, right? And pulling expertise out of different universities.
Yeah, well, one of the methods that we're using to deploy capital is to engage universities at a very vulnerable time in their discoveries. And this is usually around that moment where funding for a particular idea that's been funded by the federal government through NIH grants no longer is eligible for that funding. And yet it's still too early for the conventional venture or for industry for that matter. So, these ideas, we call this area the Valley of Death. People referred to this in life sciences before. Lots of good ideas, too few people, too little capital, and too little patience. So rather than try to solve for all these individually, we decided to create some internal capabilities for drug discovery. We created a group called 3DC, which is a Deerfield Discovery and Development Corp. It's a group of very experienced drug discovery professionals in gene therapy and small molecule antibody peptide therapy. We partner with the university, and we partner in a very formal way with a couple very unique distinctions. Real value creation, I'm talking about monetary value creation, is only going to occur if there's human benefit, true, real, impactful human benefit. So things need to work. But we need to be able to fund an idea completely through the life cycle. So it's a little bit different from the conventional where a venture firm will start an idea and then start to de-risk their investment by syndicating it out. We're going to guarantee that the programs in the universities continue to receive funding as long as the scientific merit and the development tractability continues to support that all the way through the exercise. And we're also going to we've created a model that allows the institutions to participate in the value creation of the equity that ultimately comes out of these ideas. And I point to a couple of examples, notably at the University of Pennsylvania Children's Hospital, so Children's Hospital of Philadelphia. Some very groundbreaking work occurred in the field of gene therapy for back of the eye, led by Dr. Catherine High. And they created a company by the name of Spark Therapeutics. Spark was eventually acquired, and it was a very profitable payday, but Children's Hospital was able to hold on to roughly 10% of their equity stake. And that translated to about $600 million coming back to Children's Hospital. So we had a human health transformative event. We also had an economic event for Children's Hospital that was really great. So we're trying to do this at scale and a method and a process that, getting back to my earlier comments, where failure rates are really high, and you want to reduce the cost of failure. So rather than creating all these silos, we create a mechanism, and then we partner with the university in a formal way. It's still an experiment. So we'll know in about 10 years how well we did, because frankly, that's the time frame that life science drug discovery needs to be thinking of, 10 years.
Bet you have a good read on who's good at what, though.
Well, we know that there's a lot of great discovery, and that doesn't exclusively reside in Boston and South San Francisco. Some of the best discoveries in human medicine, WashU, University of Illinois, Chicago. I mean, these are not the conventional names that you read about that also where venture capital hubs are situated. And yet they've made a major financial impact and a human health impact.
I want to try and get Zach to talk again, but before I do that, there's a question. Bobby, people are asking about that event you're having next week. Do you have the information about it?
It's not my event, something we're trying to help on. I don't have the information. I will try to get it and share it with folks at CSIS. I'm sorry, I don't have it.
Right. So anybody who's interested can go to the CSIS people and get the information. But Zach, you must have thoughts about the last few minutes of conversation.
I've been kind of noodling on it, and I was trying to map out in my mind.
I can tell you look pensive.
I was trying to map out in my mind how long it took for Research Triangle Park to really become renowned, and how long it took for Austin to really become known as a tech hub. And it's still probably on the order of 15 years, or if we want to give some more grace, we could say 10 to 20. But I don't necessarily know that that's a bad thing, because I think organic growth and the attraction of, people to a new city and for, culture to change and all that sort of stuff to happen takes a while. I don't know if you can force it in 2 to 5 years.
Well, but what if you get $1 billion?
Well, you could change my mind. You just give it to me and we'll see what happens.
Well, but I mean, it could work and it could not work, right? So what do you do with it? What would you do if Houston got $1 billion tomorrow?
I think you either shore up or create whatever's missing in your particular region, right? So we talked about the importance of academia for talent and research institutions, and successful companies, right, and customers, and sort of creating opportunity for those things to collide. And so, I think innovation hubs, innovation centers, like large complexes of buildings where people can come together and share ideas, hold pitch events, have elementary students come, have research labs all in one space. I think those are additive to an ecosystem. I think large, sophisticated, medical research centers are fairly additive. And I think large research institutions within academia, I think that's where all these things start. And then organically, your best and brightest students usually branch out, start a company, hire from within, hire, as they grow, they hire more experienced talent from established companies in the region, and these things feed on themselves. And as they exit, the top 15, 20, 50, however many people, then go off and spawn new things.
I think what this panel has proven is, if you're going to get $1 billion tomorrow, bring VCs into the conversation. There is one more question that we've only got a couple minutes, but someone's asking, can we expound a little on the $1 billion thing that I've referred to? And I'm going to turn this to Bobby, but I do know that there's a Brookings Institution paper that kind of started the whole thing about putting $1 billion into these markets. And there's an MIT group, is it called Jumpstart America, that has also, and they both have lists of who they think should get the $1 billion. But Bobby, why don't you provide more context around that?
Well, there's one that's already passed Congress, and there's one that's being considered by Congress. So there's a couple of different things. What I was referring to earlier is something called SSBCI, State Small Business Credit Initiative. You can go to the Treasury website and search for SSBCI, and you can get information about that. Years ago, there was a pot of money that was distributed to the states. States did stuff with it, some venture, some different. They all get to decide exactly what they're going to do and how they're going to do it, and they submit that to Treasury before they get the block grant. In March of this year, Congress passed almost $10 billion towards this program. Not all of it goes for the same thing, but it will be block granted out to the states. So capital is likely to come to states over the next several years that can help different areas of the country jumpstart a lot of this stuff. Then the other thing that we're talking about, and Steve Case mentioned it in his comments, is the Endless Frontier Act, where it's the idea of the regional centers and looking at, different types of technology and making sure that we in the US jumpstart the R&D that we used to spend a lot more of our GDP towards R&D than we do today. And so this is a way to try to, catch up from a generation of reduced R&D spending as a country to institutions of higher learning around areas that we want to not cede to China or other countries around the world. We want to keep a innovative global leader position in. And Bobby, that is something that is not
Endless
yet.
Frontiers Act turned into the U.S., what is it called? Competitiveness Innovation Act?
Correct.
Which has passed the Senate and now it's still in the House, is it?
It has not become law yet. And so that is the people refer to it as the China bill. It has lots of different names. We had all of our, advocacy when it was called the Endless Frontier Act. So I continue to call it by its original name. And that's where, as you said, on a bipartisan basis, a lot of people came together and said, this is very important for the country to stay competitive. So two different things. SSBCI is about 10 billion. This is much bigger than that. It's just not yet passed.
So you guys, this was an awesome conversation. Thank you for all your ideas. Thank you for putting up with my pokes. And let's do this again sometime, because, and I think the takeaway though, the big takeaway is, if you're grappling with this in the middle of the country, you got to have VCs involved in this conversation. You guys know a lot about it. So thank you so much for sharing your knowledge.
Thank you for having us.
Thank you.
Thank you.